Hi, my name's Dominic, and welcome to another Options in Oswald. I want to talk about the investment today in this current market environment. Very simple, very easy. Markets are crazy. Up, down, sideways. Do we buy the dip? Should we sell the rallies? Should we go to cash? Should we stay, buy and hold? Nobody knows. So let's talk about a real simple investment. What if I can get market returns without market risk? Well, too good to be true? Absolutely not. How do we do it? Well, let's use an example. What if I could give you 60, 70% of the upside from here, from the current market value, but mathematically protect you if the market drops another 20%? That would be your cake and eat it too, wouldn't it? Because a 60-40 does not give you 70, 60%. In fact, a 60-40 maybe might give you 55, 50% of the upside. In fact, this chart right here shows you that a 60-40 in 2009 captured 44% of the upside. So if you can get 60 or 70% of the upside mathematically and 20% buffered on the downside from here, that would be shaping the distribution curve. So let's talk about how we can do that. Well, it's real simple. Let's assume $1 million invested. You take $1 million and you put it in a Treasury bill. Now, a Treasury bill is bought at a discount from its par value. Treasury bills were trading as high as over 2%. They've come in a little bit, but the way Jay Powell, head of the Fed, is going, probably, I think we're going to see the one-year T-bill over 2%. But let's just say we can get 2% on T-bill. Well, we would buy it at a discount. So you would take $1 million and you would take the present value, the future cash flows. So if I wanted $1 million in a year, I would invest about $980,000 in a T-bill. Well, if I had $1 million, I'd have about $19,000, $20,000 left over. What can I do with that $20,000 left over? I can buy options. I could buy options. Now, a client says to me, well, wait a minute, options are risky. We're talking exchange traded. We're talking no counterparty risk. They're mathematically defined. So what if I did this? What if I just was able to buy enough options? And what if we can get 60, 70% of the upside with a 20% buffer? Now, in this particular example, we did build this for a client. We did have to take a 1% negative carry cost to get enough money to be able to get 60, 70% of the upside. But that's still extremely good. So what does that mean? If the market's down 20, you're down 1%. If the market's down 23, you're down 3%. If the market's up 20%, you're up 70% of 20%. So you're up 14%. So you're making money from the current value, but you're not losing money from the current value. It's a simple strategy. Invest most of my money in T-bills, put a little bit of money in options, define my risk today for tomorrow. Very, very simple. Everybody should be looking at this. This is a no-brainer. Thank you.